welcome. This is Christie Hamilton, and today I will be joined with Dominic Garcia as we talk about real estate investing. Dominic has spent about 18 years, actually, he spent previously 18 years as a public pension allocator, first or in Wisconsin, and then more recently in New Mexico, where he ended as the chief investment officer of the New Mexico pension there. Um, Currently, he serves in the role of chief pension and investment strategist at CBRE, where he basically works with the CIO there and helps their clients put together strategies. Obviously, he's got a really great background in real estate and really interesting things to say. So I'll go ahead and kick it off with a question. You basically have had a really unique vantage point, particularly versus others. And as you look at market forecasts going forward, how are your future expectations impacting the way you think about investing? So, like, how does it impact the way you think about constructing a portfolio, and then, particularly within real estate, how that all fits together?
Sure. So Christy, it's a pleasure to be here and pleasure to have this chat with you and all of our friends at CFA Boston. So thank you for inviting me. So I think the first step, if you think about where we are in kind of the investment world, I truly believe we're in a new paradigm shift on the investment world. I think over the last 30 years, what we've experienced as investors, and particularly me in my career, 20 plus year career, I don't think it's going to be anything like that going forward. There's been a complete shift in every dynamic going forward. I think the last 30 years or so has kind of been a peace dividend, right? So let's call it that. And so what I think is important to understand is if you really think from 1992 to, I call it kind of the Ukraine invasion, that was the peace dividend. And I think there was a lot of things that were tailwinds, monetary policy, globalization, et cetera, that was very supportive of investors and investors building portfolios. Those things are now reversed and are actually headwinds going forward, right? So I think what that really means for investors is you should really go back to really look forward. And so from my vantage point, I think the impact that we're going to see in markets, not only just for real estate and real assets, but for stocks, bonds, et cetera, is more like the Cold War, so 1950 to 1992. And I think if you really look at that time period, look at those data sets, and try to understand what that world was like and how assets interacted, acted, et cetera, I think that's going to be very, very telling for how to build portfolios going forward. So in a very short, I think it's an investment paradigm shift we're living in, and I'll go into a little bit more detail about it, but it's an entirely new world that most of us do not have experience in.
Well, so as we dig deeper into that, how would you think about, let's say, investing, a new portfolio, if you will? I would love to get your thoughts specifically, on the real estate side. So, what are your thoughts on commercial real estate? And, let's kind of unpack that, because I know it's a bit of a touch point right now.
Yeah. So if I may, maybe take a step back and just expand a little bit more.
Oh, please do. Sorry.
Yeah, and then I'll dig into commercial real estate. But I think so in this new world, what I think investors need to expect is kind of macro factors. So things like inflation. Inflation is a big one. Interest rates, et cetera. I think you'll see the volatility of those increase. I think you'll see bigger tails. You'll see more non-normal distribution of those macro factors. And so what that actually means, I think, Christine, I think this is part of why I think real estate and real assets become quite important, is in that environment where you see broader non-normal distributions of macro factors and increased volatility, equities can actually disappoint for long periods of time in that macro environment. In fact, if you go from that 1950 to the 1992 period, equities disappointed quite a bit over 10-year periods of times. And disappointing means it underperformed CPI, right? So if you really think about where investors are today and what investors have done over the last 30 years, investors have been pushed out on the risk curve, right? And basically have just bought and digest and increased their equity risk in their portfolio, particularly since the GFC, right? So zero interest rates really pushed investors out, and investors did it. You know, most portfolios are pretty far out that risk curve, right?
Absolutely.
But I think now in this new environment with rates, with the rate regime different, there's kind of a silver lining to all that. Investors can now meet their required returns with a different risk profile, right? So you can kind of re-risk, do a giant rebalancing of your portfolio. And I think the big beneficiary, the big place where you can kind of rebalance that risk is in real estate, real assets, infrastructure, right? And I think that's the setup for us to think about in the world that we're living in. So I'll pause and see if you want to dive into real estate a little bit more.
I would love to first, I mean, so yes, I do want to talk about commercial real estate, but kind of, within that, obviously maybe commercial real estate isn't the place to start, or at least not, when you're thinking about kind of re-risking and where to put money to work within real estate, but, um, where are your favorite places at this point? And then we'll kind of talk through more specifically. So kind of high level, just, where do you think people should be looking right now in real assets?
Yeah. So broadly speaking, I think, so again, let's say if you can re-risk some of that equity risk that you have, where do you deploy it? I think you deploy it into things that are income and real return, right? And so real assets becomes a quite interesting spot for that, right? And I think it's a mix of both real estate and infrastructure. Infrastructure in particular is quite intriguing in that world, right?
Perfect. Well, I love that I think we're going to do a deeper dive on that in a second. So yeah, now let's go ahead and go back. Let's go to commercial real estate because I know that that's getting a lot of headlines right now. What are your thoughts on that strategy in particular and kind of what's going on in the space?
Yeah, so commercial real estate is going through a stress period now in the repricing. And I think the center of that repricing is really office, right? Post-pandemic. And a lot of that, obviously, this is no new news to, I think, most people on the call, workers, firms have kind of, the way we work has changed quite a bit, right? And so you see that disruption occurring real time. The other big piece of commercial real estate has been retail, and obviously that disruption has been happening for, I don't know, decade or so from the Amazons of the world, right? But I think the office piece is quite present and and happening real time. So if you take a step back and you look at kind of what has happened, so I like referring to kind of the public markets in real estate. So if you look at the public REITs and specifically the public REITs in office has corrected, let's call it 50% or so over the last 18 months-ish, right? Mm-hmm. On the private side, on an Odyssey basis, that's only been about half. So you're seeing a real-time repricing that maybe hasn't played all the way through on the private side, right? And a lot of that obviously is the disruption of work. And I'm going to give maybe a couple of factoids just to give you a sense of kind of why that repricing is happening. So I think from a CBRE estimate, we think like something like 700 million square feet of office will be in surplus, right? Just from folks, just the change of demand and working, and the changes in your shift between home and work, and frankly firms kind of downsizing. That's 700 million square feet. So another factoid, CoStar estimates that about 3,400 properties that have 50,000 square feet or larger, about half of that, about 50 of those properties, about 50% are in vacancy, right? So there's a lot of emptiness, I guess, in office right now is really the point.
And I mean, do they expect that to continue? I know it's very cool right now because workers are, wanting to work from home. Do you all see any kind of longer term trend that maybe that'll turn around or no?
Yeah. So the way I like to kind of talk about it is, I think the word inspiring is quite important, right? So I think for workers, you're really competing with home. You're competing with, making the commute better. So I think for office, I think inspiring spaces and spaces that make the commute a little bit more attractive, I think those can be winners, right? But the non-inspiring, I think what you're seeing is honestly, you're going to see a lot of entrepreneurialism there to kind of get those things moving, right? So conversion into housing, conversion into, whatever folks can imagine. And I think so you're going to have these haves and have-nots in office. And quite frankly, I think, to take a playbook out of another asset class, I think you can think about office in terms of kind of a deep value stock, right? There's potentially, value in kind of a repricing in some of these properties, but it's going to take a long time to get that value out, and you may never, right? So
Sure.
I think that's a really good analogy to think about what's going on in office.
That's interesting. I also kind of think sometimes it's a value trap. You got to watch out for those in that instance.
Yeah,
Um,
I don't disagree, and and again, I take a step back and think about my experience as an allocator in the equity land. Deep value stocks were value. There was a value trap for a decade, right? And
yeah.
I think that's a similar analogy. Now, I don't want to paint a broad brush that everything is bad, because that's not true. But there's traditional office, legacy office is definitely in a stress, and hopefully there's great ideas to convert those and unlock value. There are other pockets, right? So I think within life sciences, healthcare, I think you'll find that in those kind of industries, 90+% of the workers actually have to be in the office, right? So you'll continue to see strong demand for that. And then I think maybe in some pockets of geography here in the U.S., kind of Sunbelt cities, I think you kind of see continued demand. Maybe folks that are moving out of the bigger city hubs, and that might continue to do well. Places like Miami, San Diego, Phoenix, those places kind of continue to have some, I think, some tailwinds. But the bottom line is, if an investor thinks of office and thinks about those kind of non-inspiring spaces, or even the inspiring spaces, I think you got to really think about the opportunity cost of it, right? So if you have the ability to go in there, take that value, that value, and take the cost, as it comes down, have the idea to retrofit. It's going to take time to get your return and get your money back. At the same time, there's an opportunity cost, because there are preferred sectors, and there are sectors that are going to be doing well relative, and then there's infrastructure as well. So you really need to think about your opportunity cost of where that marginal capital goes.
Appreciate that. Real fast, what makes the space inspiring? Like, are there specific kind of things to look for? Is it it when you see it?
And again, this is just going to be my own personal view. I'm not an asset operational guy,
Sure.
but I think it's a little bit as you see it, you can feel it and see it when you're there, right? And I think we all have a sense of, oh boy, if we just have a whole bunch of cubicles lined up against each other, that's definitely not an inspiring space.
Yeah.
Something that I think entices collaboration, something that has light, something that's not that's a convenient commute. Those types of things, I think are going to be quite important.
Like, convenience is always inspiring, right?
Yes.
Kind of, what are your thoughts on residential real estate? I know that that's another space that's kind of acting a little bit differently than what some people would expect. Not as, kind of headline grabbing, but something that a lot of people are having headaches with right now.
Yeah, I do believe within the real estate, I think residential is an attractive spot, right? And that is a place where I think relative to office, you can see some gains, and you can see some positive returns. And I think the fundamental reason why that's important is, I think there's just frankly a structural undersupply of housing throughout the United States, right? And I think the demand supply dynamics there are just a are just, it's a very strong theme throughout the United States in almost every city. I think some specific areas within residential that are quite attractive are, kind of student housing, right? I think all over, universities and college towns, et cetera, there's always a high demand for that. And quite frankly, the other one on the opposite side, with the demographics is senior living, senior housing, right? And so I would see those as continued strong tailwinds in both those areas, and broadly speaking, residential.
Nice. Okay. So I know one that we talked about quite a bit, when we chatted before. I would love to get your thoughts on infrastructure right now and kind of what you like there as well. Because I know while it's not, necessarily kind of core real estate, it's definitely part of, a inflation hedging portfolio and a real assets portfolio that's important. So I'd love to get your thoughts on it.
Yeah. So I think a couple of things. So one is, I think you're starting to see some areas where real estate and actually infrastructure start converging a little bit, right?
Mm-hmm.
There's a little bit of places where there's overlap, but broadly speaking, let's take a step back and kind of think about maybe a 101. What is infrastructure, and why is it important, and why is it attractive for folks? I think for infrastructure, just the definition of it, because there is a haze with real estate, is it's a monopolistic kind of asset, right? Because whether it's regulatory or people need this every day, there's no real substitute for it, right? I think that's an important feature. The second thing is it's long lived, right? So you're going to have even longer lived than real estate. Infrastructure is a very generational type asset, and so the question becomes like, okay, so why do I want this in my portfolio? Well, it turns out I think infrastructure has some really interesting and unique characteristics to it. It's probably the one asset that has kind of three fundamental kind of factors to it that are quite attractive for portfolios, right? So it's kind of an all-in-one asset that has high income. So by the way, most of the return is income generated. It's very inflation sensitive. It actually, when inflation changes, it actually adjusts quite well and quite well correlated to it. And then there's a little bit of growth to it, right? And so when you actually put this in combination, infrastructure actually has it's quite diversifying to other things in your portfolio, and the income and the inflation adjustment is quite strong and adjusts as time goes along. So I think it's just a really powerful addition to a portfolio, period. And so what you see in infrastructure is kind of, I'm going to make it simplify the world and what's going on in infrastructure as kind of legacy assets, and maybe let's call it next generation assets. So legacy assets you can think about are really kind of things that we would think about every day. Your power generation utility that's maybe more carbon based. Your water utility, et cetera. Those are obviously highly attractive, very compounding and of the income. But a lot of those assets have been bid up quite a bit because a lot of investors have been pouring in there. So the valuations, some argue, can be high. And then second is kind of these new generation stuff, more, renewable, clean energy, everything digital type assets. And so that's where I see a lot of growth and a lot of attraction and higher returns, but also maintaining those same fundamental values and those same fundamental factors of infrastructure. And there's a little bit in there that kind of crosses over with real estate on those everything digital and those clean technology. So everything digital could be basically you're supporting the demand for cloud technology, right? So anything from towers to data centers to fiber, et cetera. And then clean technologies is really just kind of that energy transition that we're seeing from carbon to things that are more renewable. So that can be anything from sustainable transport, sustainable grids to frankly just wind and solar. So all those areas are just bursting and burgeoning quite a bit.
That's really interesting. Kind of as I think about that, starts to make me wonder about, how we would even consider building an asset and or a real assets portfolio at this point, especially given where rates are and kind of the different factors that we've discussed up to this point. Kind of as you think about creating a diversified portfolio of real assets, how would you structure that?
Yeah. So again, maybe we started off by saying, hey, look, I think
Yeah,
the world, I think the world, um, the world is, we're in a new paradigm shift.
sure.
Inflation. I don't know where inflation is going, but I think it's going to be more volatile. Rates will be more volatile than what we've ever seen. What do you need? What do investors long term? What's important for them in their portfolio? I think you truly need a diversifying portfolio that diversifies by these economic regimes, right? And so real assets actually become a quite interesting piece of that. And so when you actually think of, well, what can a real assets portfolio look like, and what contains it, right? So I think of one, let's really think about real estate and infrastructure. I think those are kind of your centerpieces of the portfolio. How much private do I want to do? How much public do I want to do, right? And so I would think for, a public private, what I found over time is you want about 70% private and about 30% public, both real estate and infrastructure. You want to lean a little more infrastructure because infrastructure has a little bit more of that inflation protection, higher income production. So you want to lean a little more infrastructure. And then within that, I would argue that you want to focus on core plus type strategies, because you're gonna keep to those fundamental values that I discussed. Getting more of the inflation protection and income versus the higher growth and GDP sensitive factors. So at a broad view, that's how I would first look at a real asset portfolio.
How much would where would you size it relative to the larger portfolio?
Yeah, so I think going forward, I think the new 60/40 is a little bit different, right?
Yeah.
So I think investors can get to the required returns and have a better diversification of those economic factors by being, I think, 40% equities and 30% real assets, and then 30% bonds and income, right? So I think a real asset portfolio can get to be about 30% or a third of a portfolio, unlevered, right? An unlevered portfolio.
Certainly. No, I appreciate it. It's a much larger percentage, I think, than what a lot of people are used to. But I mean, it makes sense kind of logically within the, kind of the broader expectation of risk, coming up that you threw out. Okay, so now can we drill down into that real assets portfolio? How would you,
Sure.
I know that you said kind of broadly how you would structure that, but, how do you think about constructing that diversified portfolio? What specifically would you put it in, and kind of what specific risks would you consider as deploy capital into this space?
Yeah. So again, if you're putting 30% into real assets, what you really want, why you're doing that is because you
Yes.
think the expected return is at least as big as equities, which would be kind of the source capital, right? And you think the allocation of real assets gives you a diversification benefit relative to equities and/or is lower volatility, right? So your overall portfolio should be better sharp with a similar or better expected return. And I think you can do that. And so within real assets, again, I think the first spot is, let's just really talk real estate and infrastructure. I think you want to tilt towards infrastructure. And within infrastructure, I think what you would want to do is you'd say, hey, I want to tilt about 70% of that portfolio into private infrastructure and about 30% into listed or public, right? So in that 70% that you're putting into private, I would focus on core and core plus type strategies, right? And the reason why I would focus on core and core plus strategies is that's staying true to those economic values I discussed, right? Core plus is going to be higher income component. It's going to be a higher, you're going to have good correlation to inflation changes and minimal GDP effects, right? Or minimal growth sensitivity. Now, in that core plus, I would stick to an open-ended vehicle. And so I think this is a very important point for investors. The differentiation between open-ended and closed-end, I think, is huge. So in infrastructure, I think that core plus allocation, you can probably get 8, 9, 10% expected returns over time. And in that open-ended vehicle, you're invested, pretty immediately, depending on Qs, et cetera. But you're invested immediately, and you're compounding the entire time, right? In theory, in infinite, in infinity. And that's really important because of the high income component of infrastructure. So just to give you an example, so let's say you invested 10%. I mean, let's say you're invested in an open-ended vehicle in infrastructure that generates about a 10% return, time weighted over time, versus going out to value add opportunistic type strategies, which, by the way, emphasize more appreciation, more GDP, more equity risk, basically, than income and inflation diversification, right? That's going to be in a closed-end vehicle, right? And again, in that closed-end vehicle, your capital is going to be deployed over a 10-year period, and on average, you're going to compound maybe four years out of 10 instead of all the time, right? And so that's a very high bar to overcome. So what that actually means is your IRR in those closed-end funds need to be 25-ish plus percent to get the same kind of wealth generation. So I think if you focus more in the open-ended space, core plus, you're going to get a very nice wealth compounding over time, relative to, and you're going to stay true to the diversification versus what I call is kind of a diversification, right?
I can appreciate that. What about on the real estate side?
Yeah.
How would you build that out?
Yeah. And so the last thing I would say is
yeah,
on infrastructure. And so on that core plus, I would emphasize a bit like kind of mid-cap-ish assets, right? So the mega cap assets, right? So giant airports, et cetera, those have been bid up quite a bit. So I would tilt a little more towards mid-cap-ish and those renewable, clean energy type sectors, right? A tilt there. So on the real estate, I would analogously, I would do very, very similar, right? So a 70-30 type allocation, private, public, core plus allocation, right? The same thing about open-ended versus closed, and I think is the same here as well. And I think there's a lot of research that shows that the core plus or the Odyssey type funds, if you actually levered them or had them invested at the same risk of value add or opportunistic funds or the same LTVs, they actually produce a better Sharpe ratio, right? And so I think it's the same issue that you see that I discussed in infrastructure. So the Odyssey fund open-ended vehicle that's highly, has a high income component, some inflation protection, and then a little bit more growth. I think you getting that compounding every day, all day, relative to the value add and the opportunistic, where you're only compounding on average 4 years out of 10. It's a high bar to get that IRR relative to the Odyssey. And in theory, if you can just get your Odyssey levered a bit or improved, levered or at the same risk, you'd be better off, right? And so that's how I would focus on core plus, Odyssey, open-ended vehicles. And then within real estate, it's a very similar theme, right? Those legacy assets, those legacy sectors, I would de-emphasize for more of the next generation sectors. And so those would be residential, logistics, I think is a quite interesting spot. And then within residential, I think even affordable housing. And so you tilt, and then maybe you start getting a little gray area with infrastructure, right? So data centers, et cetera, there's some overlap there, right? So I think those kind of next generation sectors would be the major tilts. that I would have from a core plus open-ended, kind of Odyssey type implementation.
You mentioned logistics specifically. What do you like in that space? I know that that's kind of a hot one right now that a lot of people are starting to get into, but they don't necessarily, everyone just says Amazon. Um, kind of what are your thoughts there?
Yeah, no, I don't know that it's obviously it's the Amazons of the world, but I think
Yeah.
the major tailwind is kind of is the retrenching of globalization, right? So
Ah,
so you're seeing supply chains kind of reorienting entirely, and so I think logistics centers, particularly in the U.S. or near U.S. or onshore, near shoring, I think is that's kind of the reverse of globalization that you're seeing, right? So key, so I think key hubs in that new supply chain are going to be quite important. And then secondly is a lot of those logistics centers need to be pretty high tech, right? And I've some of those, quite frankly, the firm I work for, we have experience managing those warehouses, and quite frankly, a lot of them have very little human. There's a lot of robotics involved in those warehouses and those logistics. So ensuring that you have a modernized facility to actually house and support that technology is key.
interesting. Can't just build a warehouse anymore and have them come, can you?
Yeah, no, I'm not an operational expert, but there's a lot of support needed to meet the high tech needs of those of the Amazons, the Walmarts, all of them, right? They're all in that same game of being ever more logistically inclined and smarter of getting their value, their supply chain more efficient and cheaper.
Great. No, I appreciate that. I think that that's a great way to think about building out a portfolio and, also kind of going through the what's interesting. And obviously people out there listening can ask questions if they so choose. I believe it's in the chat. But I would like to ask you kind of adjacent to real estate. Um, in your current role, you've basically transitioned from, more of an allocator role specifically, and now you're taking that experience and providing it like the expertise and everything that you've built up to a group of LPs. How has that transition been? Kind of how do you think about transitioning and advising people versus kind of going in and actually putting the capital to work?
Yeah, so a couple of things I think is first of all, I have a better, it's been about 2 years since I've transitioned from an allocator to the private side. The first thing is I have a better understanding of where fees go, right? So,
Ah.
so I thought I knew, but now I really know, and I have a better appreciation of just the sheer work effort it takes to service clients and produce value add, right?
Right.
Um, so, um, so I have a better appreciation for that, right? Quite better understanding.
I
The
can
second,
appreciate that. Wait, where do the fees go?
yeah. So, it's not a when you're an allocator, you think, oh, you could just you could just save money here and there, but no, having to serve clients, I just have a much better appreciation for what's involved in that. The second piece is you know as a former CIO, when you talk to your board or you talk to even sometimes your staff, there's always a skeptical look. There's always like, oh, what do and that's just part of maybe the separation of roles, the due diligence, etc. So I felt like I had to speak a lot and get my point across just overwhelmingly a lot. Or sometimes, frankly, you just didn't get, you felt like maybe you weren't getting listened to. In this role, I feel like everybody wants to listen to what you have to say, right? Whether if it's good or bad. I just have more open ears, and I found that that's quite, that was a little bit of an interesting realization for me. It's just the ears were more open than I've ever noticed. And I think the third thing is just realizing how different investors are, right? And from one investor to the other, well, well, there might be a, one pension might have a very similar strategy as another, or one endowment might have a similar strategy as another. Well, they're not, different in the investment strategy they have, but their organizational idiosyncrasies are quite different, right? So they might have a different governance structure, or they might have, there's so many different things that it isn't so much strategy, but just kind of idiosyncratic nuances that differ from investor to investor, and trying to understand that and understand their problems or their goals a little deeper. I think I've built a more appreciation of that.
I appreciate that. We're getting some great questions out there now from the audience. I don't know if you can see these as well, Dominic, but I'll just go kind of in order. What is your view on the future of life science properties?
Yeah, so I think I think I mentioned it earlier, but I think life sciences life sciences might be one of those pockets within the office space, right? And I think part of it is probably a few tailwinds. Number one is, I mentioned it. I'm sorry to be a broken record, but 90% plus of workers need to actually be on site at a facility, right? So I think you'll continue to see demand for life sciences, et cetera, in that regard. The second piece is obviously healthcare, and research oriented with healthcare is going to continue to grow as just a sector, particularly with the demographics of our aging population here in the U.S., but also globally. So I think there's a few tailwinds to life sciences going forward, quite frankly.
I can appreciate that. The question has quite a few parts to it, so I'm just going to kind of break these down. But starting off at the top, what are your thoughts on private real asset classes, like farmland, timberland, energy, metals, and mining? So I guess let's start with farmland, because I know we chatted about this before. What are your views there?
Yeah, so I guess that question really is getting to, okay, let's talk about building out a real asset portfolio. I suggested your real asset portfolio should primarily be real estate and infrastructure, but there are others, farmland, timberland, et cetera, that you can add. And and I have a history of doing those as an allocator, and I think there's maybe a couple of things that I would say. Number one is, in theory, they're a great diversifier, right? So farmland, timberland, there's not a lot of correlation with so much with what's going on in the economy. It's really kind of more how well you're managing your land and how well your stock is growing, right? Now, that's great. But I've also found as an allocator, actually very tough to find to actually put that money to work, right? And when you actually do, it takes quite a lot of time, and the expected returns, quite frankly, are not. There's not a premium over and above real estate or infrastructure in those expected returns. So to the extent you can put a couple of percent to work, it's just marginal, quite honestly, and it takes up more time than necessary. So that's what I found over time. It's just it's hard to put money to work, and you don't quite get the bang for your buck, and it's a little bit of a drag on your overall real assets portfolio.
Certainly. Well, and it's also funny because I remember kind of back in those days, how do I think about managing a timber farm? Like, how do I deal with my like acorn farm in South, or I don't think it was acorns, but there's like, different kind of niche areas you could go, and it's like be on site in South America and have no idea how to value it except for kind of in the aggregate. So my point being that it adds a lot of cost to managing at times. So it helps to have kind of a real understanding of those spaces, and not just thinking about it as scattershot real assets investing.
Agreed. I totally agree.
What do you think about the credit side? That's something we haven't touched on as much, but I'd love to get your thoughts on kind of real estate credit and actually infrastructure credit as well.
Yeah, so a couple of things. So take a step back. I said I think there's a new 60/40, right? And sure. And so not only is real assets a beneficiary of kind of that change of, let's call it a rebalancing, I think credit is as well, right? Whether it's private credit in real estate infrastructure or just private credit in mid-market companies, I think is an attractive place to generate return. So I think specifically in real estate and infrastructure, I think you can. It's a super attractive return stream that you can get, consistent income, call it 8 to 10% income yields that are backed by high quality assets. So you as a lender, quite frankly, I think you can feel good that your capital is backed with good collateral. So I think that's a quite attractive space. The other piece is, particularly in this environment, I think you can get it on a floating basis, right? So you get a floating relative to, call it SOFR, and I think you can minimize kind of duration of that portfolio. So minimal duration, floating rates, which can adjust. Frankly, they adjust pretty quickly. To call it a 12 to 18 month period where you can adjust back if rates change, and 8 to 10% yields potentially, backed by high quality assets, I think is an attractive space. And so I think both real estate credit and infrastructure credit can be part of your portfolio, whether it's depending on you philosophically, whether you want that in your real assets book or you want that in kind of your bond or income book. But regardless, I think you want it overall.
Well, kind of drilling down within that, though, I've been hearing a lot about commercial real estate credit. Is that kind of one area that people are trying to stay away from, I guess, just given the overhang and like what's expected and what they expect to wash out?
Yeah, yes. So one layer deeper, I agree. So there are, I think as we just have discussed earlier, there is a benefit to having a manager that understands different sectors, right? And so right. So a lot of lending to legacy office, probably it's not a senior, might not be a senior secured spot, right? So So I think there is some importance for differentiation between sectors, but nonetheless, I think leaning towards industrial, logistics, residential, those types of things, I think is still attractive within real estate space for credit.
I appreciate that. When you think about kind of the new paradigm that we're moving into, I know we've talked about that kind of multiple times throughout this conversation. Do you think that there's anything specifically that investors should be thinking about as they kind of enter into this brave new world? Like, kind of, if you put your allocator hat back on, and as you think about advising them, is there anything that people aren't considering, or things that people, maybe risks that they mispriced, or stuff that you're seeing out there? Like, do you have any advice for people as we enter this new age?
Yeah, so I think maybe a couple of words of wisdom, so to speak. One, right? So I think most investors, whether you're a pension, endowment, et cetera, you really have moved out the risk curve, right? Whether it's equity explicitly, or you bought high yield, or you have kind of gotten equity like risk all over your portfolio, right? And investors kind of had to do that, right? Because rates were at zero, et cetera. Well, you don't have to do that anymore, right? You can actually re-diversify your risk accordingly. But I think the first thing I'd say is really think about that, right? So think about what is your required return, and can I get there in a better way, right? And the better way would be, can I take less risk, and can I actually, I actually need to prepare for different environments, different economic environments, right? I'm sorry to be a broken record, but we've lived in a world where inflation was subdued. It didn't really move a lot. Rates were very supportive. Monetary policy was very supportive. Well, those things are going to vary. My expectation is those will vary a lot. So you want to have a portfolio that can perform in different scenarios, not just the one scenario, right? Where equities just keep going post GFC, right? So I think that's number one, is really think about what is that portfolio. And I think that portfolio is more income, more inflation sensitivity, right? And so when you do that, how do I actually execute that? How do I actually put that into my portfolio in a thoughtful way? I think is an important point. The other important point that I'd emphasize is this idea about open versus closed-end vehicles, right? By and large, closed-end vehicle investing, you're really going after more equity-like risk, right? So you need to be quite careful of if the goal is to re-diversify my risks, but going into a closed-end vehicle or closed-end vehicle type strategy, you're kind of just doing the same thing again, or you're diversifying yourself, right? So be very mindful of how much of that risk that you redeploy in privates isn't just more equity risk that you already have, right? I think you got to be very, very mindful of that.
I can appreciate that. I think a lot of times, or for the longest time, we would kind of bucket things, or the best practice in the industry was to, here's my hedge fund bucket, and here's my public equity bucket. And now it's like you really have to think about what are the drivers of this risk, or am I ultimately just getting equity, or am I actually getting something that is diversifying to the rest of my portfolio? I think particularly when people hit that 60-40 and inflation hit and then both went down or both sides of your portfolio went down and everybody's like, I thought that this was supposed to protect me. It's like, well, in this one specific paradigm, um, I mean, by that I mean when equities draw down and your fixed income helps, but when it's, inflation driven, I think everything kind of like your whole portfolio can struggle there.
Yeah, and I think the other thing that I would mention is, I spent my entire allocated career doing this,
Yeah.
and I've spent time now in my current role thinking about this is how do you separate the idea of separating out alpha and beta, right?
Oh, yeah.
How am I getting my value add um, for buying active management, and what am I getting with my beta? What is my beta?
Mhm.
How much equity risk, how much income, how much inflation risk am I actually getting? And by and large, people think about that as, hey, that's only a public market concern. Well, no, I think you can do it in private markets as well. And quite frankly, over time, the fundamental beta factors of private capital and public capital are fundamentally the same, and a lot of times converge over time, right? So the returns actually converge over time. So I think the other point I would say is be very mindful of what is actually alpha, what is actually beta, and not punting in private land, because you can actually do it. You can identify skill in private land and understand that the fundamental drivers of returns in private land are still very similar to, and in fact, probably the same as what drives returns in public land. The main reason why you're in private land is you think by being able to have extra control, et cetera, of an asset, you can unlock more value, right? And there's potentially more skill in doing that. But the fundamental drivers of returns are very, very similar, if not the same, right?
I can appreciate that. And we got a really great question that I like. It says, what about, I mean, it's multiple parts of this question, but first and foremost, what are your thoughts on real estate secondaries?
So uh, so I do think secondaries can be an interesting spot right now. So in particular, let's call it in the Odyssey space, just as in sectors, there's going to be haves and have-nots, right? So I think the have-nots are those that stuck with kind of legacy assets, have higher office allocations, higher retail allocations, and there's probably quite a few funds that have that, right? And then there's other funds or other investors that have been a little bit more progressive in investing in next generation sectors, et cetera. And so I think secondaries could be an important part for an investor to call it rebalance their portfolio and their managers. So I think that might be an active, attractive space. There quite frankly is a pretty good bid ask differential, right? So
Mhm.
I think if you're thoughtful, that can be an interesting space, right? And then if you're going to allocate via closed end, I'm sorry, I'm not sure I understand the rest of it.
Well, I think it was just I think it was what do you think about it? And, more broadly, but by all means, we can wait for a moment as we continue for them to maybe comment on what do you mean by the closed-ended LP allocation part of your question. What do you think about infrastructure secondaries as well? Like, is that an interesting place right now?
I'm not sure I have as much conviction or frankly just understanding of infrastructure secondaries as much. I would say just because there's a lot of dispersion and returns going on in real estate right now, I think there's a lot more potential activity in infrastructure secondaries. I know actually, when I take a step back, quite frankly, I think the differentiation between strategies and managers in infrastructure is quite a lot. So there's a lot of idiosyncratic managers take a lot of idiosyncratic risk, but I think there's always opportunity in secondaries just because there's much more idiosyncratic managers and strategies. So I think broadly speaking it is, but specifically, I don't know that there's any. I'm not as familiar if there's any current event that's kind of changed that structural setup.
Well, going back to the real estate secondaries, then, kind of how do you think about evaluating those, just given the spread right now? And also what are the risks to watch out for when kind of looking at these?
Yeah, that's a kind of a loaded question, but
It is, I'm sorry.
I would actually say, again, I think going to my prior comment, I would say lean on publics, right? I think publics lead in the real estate space. Public leads private, so I would look at public to kind of inform you a little bit on the pricing of assets and the pricing of sectors, and maybe that can be helpful in whatever specific secondary you're looking at on the real estate side.
That's incredibly helpful and interesting. I like that space, or I like looking at that space in particular for the pricing aspect of it. So I'm glad we got to touch on that. Kind of as we kind of come to a close in this conversation, what what are your thoughts kind of like to tie it all together? I mean, I know we definitely talked about a new paradigm shift. We definitely talked about how to build a portfolio. But kind of in closing, what would you recommend to an investor or to investors? And then I have one more question about kind of best advice you've ever gotten. So first of all, or so first, kind of what, in closing, how you would frame this conversation for investors. And then I'll end with one more question. So the floor is yours.
Yeah, I would say, broadly speaking, I would lean into real assets just for the diversification benefits of it, but don't diversify.
Yeah.
And by don't diversifying is basically saying stick with core plus open-ended type approaches. Be very mindful of closed-end approaches that you're taking. Within real assets, lean towards more 2.0 sectors, next generation. Legacy assets, think of it as an opportunity cost, and be very mindful if you're going to stick with or invest in legacy assets, be very mindful of what that opportunity costs and are you going to be able to come over that opportunity cost, because that opportunity cost is the 2.0 sectors continuing to grow and produce returns.
Yeah, thank you for that. I guess my closing question is one that I like to ask people. You obviously have amazing experience and 18 plus, actually 20 years plus in the industry on the particularly in the allocator, and then now on the advisor side. What's the best advice you've ever gotten kind of as part of your career, whether that be in investing or just more broadly speaking? Do you have anything that comes to mind when you think about kind of advice you've got throughout the years?
Yeah, I would say there's maybe a theme of advice, I guess I would say it is. So my old mentor, David Villa, who passed away in the last couple of years, he was a CIO at Wisconsin, very, very well-regarded investor. He used to speak about being an allocator, and particularly for pensions, as missionary work, right? And so if you're an allocator for an endowment or a pension, you're doing work on behalf of thousands, if not millions, of beneficiaries, right? And those millions of beneficiaries directly get get a benefit from our work. And so David used to call that kind of sacrosanct, right? So the relationship between an allocator and a beneficiary is sacrosanct. You are on a mission to help these people and build a portfolio that service their needs for this generation and the next. And he would always use this analogy of a cathedral. When you're an allocator, you may not be able to get your best portfolio all in once, but you're trying to build a cathedral, in the vein of kind of a Gaudi, right? You can see it, you can produce it, but you may not be able to build that entirely on your own, and you might have to pass it to somebody else. But you need to have a great vision and great template so that you can pass on to others. And so I took that to heart. I always felt like it was missionary work. I don't really mean to be religious about it, but just it was a sacrosanct relationship between the allocator and the beneficiary. And then now on the actual investor side or the private side, I think it's the same type of work, right? It's just now you maybe are a little disconnected from the beneficiary, but the missionary work and the sacrosanct nature is between us and the allocator, right? And being able to think of that relationship in that way is we're working together for the benefit of the beneficiaries. And I see it as my role as really understanding who are the beneficiaries, what is the objective, what is the goal, and what is the challenge that the allocator has in trying to unlock that. So I guess to put it in short is thinking of that allocator role as sacrosanct, and whether you're on this side or the side that I'm on now, or still on the allocator role, you have to treat that in that regard, and you're there entirely to do the best you can to enlarge that beneficiary pool of assets over the long run.
I really love that. Because it's like you're absolutely right, especially when you're thinking about perpetual funds, and I think pensions kind of fall into this, especially the ones that are open. It's like it truly is building a cathedral, because it's unlikely that you're going to be there for the 80 years, right? But within that, as you were saying that, I realized that also makes the investor side there, or the manager side, pieces of that cathedral. And so recognizing that they may not be directly tied to the beneficiary, but they are a huge part of actually achieving that mission. And I always appreciated the GPs that like really took that to heart. I don't know about you, but I love that.
Yeah, I do too. I mean, I think at the end of the day, if you're a successful, manager, it's all about understanding challenges or problems and then being a solution to that, right? And
absolutely,
and not pushing something, but being a solution provider, I think, is the key.
Well, and recognizing that as you bring those, kind of people will come and they'll gravitate towards that. So this has been a really great conversation. I've really enjoyed speaking about real estate with you. Again, Dominic Garcia, thank you so much for joining me during this call. And everybody, thank you out there for your questions. It's been wonderful. So thanks
Yeah.
so much, and y'all have a great rest of your day. Yeah, as you're
Thank you.
saying.
It's a pleasure, and any follow-up questions, you know where to get me.
Absolutely. Thanks so much. You guys have a great day.